The stock of the day is City Chic. The retail company says it expects to be making losses in the first half of full year 24 and pick up in the latter half of the year. City Chic reported an underlying EBITDA loss of $24 million and a full year loss from continuing operations of $45 million. Sales revenue is down by 15.8% to $268.4 million. MD and CEO Phil Ryan is confident that he can return the business to profitability with a clear strategy, with a fresh product range and normalised trade with a valuable customer base. Do our analysts hold the same faith? Well, let's hear from both Gary and Luke for some perspective. So, Gary, here's a company that was an absolute darling, particularly during the pandemic, and it's got caught with lots of inventories, and clearly as the world has moved on from shopping till we drop, we're now travelling as though we only live once. How are you looking at it, Gary?
Yeah, look, it's interesting business there. I think it's almost, its success that it's had here is actually it's worked against it into the fact that, that over the last few years, because of their rise to and success there, that a lot of retailers have introduced the oversized brands as a result of their success. So that's really impacted them. And then secondly, they've had some inventory issues of their own. So you look at the market cap, 110 mil, seems pretty cheap here when you consider the revenue line, 268 for the year. But when you look at that strong revenue line is down on the year, net profit down 45 on the year, only holding 10.9 million cash as well. So that is a concern as well, because that, if you're bleeding money here and not too much cash left there, that usually means you might have to raise more money here. So, look, to me, technically on the chart there, it doesn't look too bad here. It looks like a lot of the bad news is priced in here. So I think maybe the price can recover a little bit here, but there's probably plenty of better stocks out there to be investing in. Although I think that probably see the share price recover a bit, but it's not going to shoot the lights out here.
So if we were trying to put that into how if you hold it, would you sell it? Would you continue to hold it?
I'll continue to. If I was trying to bottom pick here and I've been caught, I'd probably be hanging on a bit longer here. But it's not one that I want to be in the long term. I'd be looking to try and exit this on a little bit of a share price appreciation, but it's got some real risks still. As our other retailers there have brought in these plus size brands, which is eaten into the competition, and the company's got some structural issues there around inventory, a bit of debt there. So it's going to be a long haul, I think, for City Chic.
Yeah, it certainly doesn't sound like a very pretty picture, does it, Luke? How are you seeing City Chic?
It's been very tough for these guys, and what a mixed reporting season for retailers. Some of them have come out and shown fantastic resiliency and actually, been rewarded quite strongly from the market. And then there's others, and the two out today, Dusk and City Chic, arguably two of the more discretionary, I suppose, and in their niches, getting absolutely smashed by the market, and probably deservedly so. The results were poor, and the outlook's even worse. So for City Chic, as Gary said, inventory was a big problem they've had now for a better part of 12 months. And in the end, they've just had to cauterize that wound and took some decent impairments against it. And it sounds like, or looking through the numbers, there is some pretty heavy discounting going on to move some of that old product and refresh for the new seasons coming forward. Because fashions is so tricky, obviously, summer and winter, but also just the trends that happen within those seasons as well. The only area I differ from Gary, I agree from his point that this is the sort of business I would probably say hold because it is so bombed out. There is a business that it can recover to. I would actually lean a sell though, Danny, and for the reason why is Gary actually pointed it out, they are running pretty low on cash. I suspect there will need to be a capital raise here. They're flagging, you pointed out, second half 24 to return to profitability. That leaves a 6-month window in between where they've already said that through the first 8 weeks, sales are down 33%. I don't think they have the cash in the bank to get them through to that profitability. I dare say any sort of debt finance that they've used in the past would be extremely expensive at these levels. Not to say that equity dilution wouldn't be expensive either, but I think that's the most palatable outcome. So it's one that I would actually exit. I think you'll see a raise here in the next few months. It'll probably be at the mercy of traders and the people who get that stock, and who knows how it'll be structured. But it's worth keeping an eye on because there is a brand and a business here that we know it will probably not get back to its former glory anytime soon, but it can be bigger than what it is today. So I'll say sell just because of that looming, what I think, capital raise coming, but worth keeping an eye on for that recovery in retail and for these guys more specifically.
Yeah, there's lots of headwinds because when we think about it, consumer discretionary income, if anything, is probably going to continue to come under pressure. And as you say, a capital raising, one doesn't dare think about the discount that might have to take place at, because the market's not silly. It'd kind of smell that they're in trouble. So yeah, totally get where you're coming from.